We'll start in a minute. Attendees are still coming in. Okay, let's start now. Good morning, good afternoon, good evening, depending on where you are in the world. I'm Nicolas Veron at the Peterson Institute. It's my pleasure to introduce on behalf of the Peterson Institute this new episode of our financial statement series. And today we'll discuss a kind of big picture perspective on the financial sector, which may or may not be viewed as connected with the fact that there is a new administration coming in the US, if I believe the news, and so lots of issues about financial reform, of course. That's not the #1 priority probably of the incoming Biden administration, but that's an opportunity to re-examine a number of priors on where we are and what reform cases can be made. And obviously what we'll discuss today is also of high relevance, not just for the US, but elsewhere in the world as well. I'm delighted today to greet Thomas Philippon and Aaron Byrne for this conversation. Thomas Philippon is the Max Hein Professor of Finance and MIT Faculty Fellow at the Business School of New York University, NYU Stern. He trained at École Polytechnique and Paris School of Economics, EHESS, as the acronym goes, in France, graduating in 97 and 98, respectively. Then did the PhD at MIT with Olivier Blanchard, now at the Peterson Institute, and graduated there in 2003. That's actually when and where he and I met almost 20 years ago. Then he moved to New York, joined NYU Stern in 2003, and has been affiliated there since. He has also taught in visiting positions at Columbia, University of Chicago, Yale, Princeton. In 2012, 2013, for a bit more than a year, he was the economic advisor to Pierre Moscovici, the French finance minister. So he took a year off in Paris. He's been involved in two numerous policy frameworks that I can mention. But let me just mention that he's been on the Monetary Policy Advisory Board of the Federal Reserve Bank of New York in the second half of the 2010s, and also an academic advisor to the Financial Stability Board and to a number of other regulatory and supervisory organizations. He's a prolific author, very highly recognized academically. In the French context, he wrote a fascinating dissection of French capitalism and the role of family inheritance there back in 2007. Unfortunately, that book has not been translated, but it's one of the best books on French business structures that I can think of. And last year in 2019, he published a great reversal, how America gave up on free markets, which was very highly praised in many quarters, but also I think gives us a sense of Thomas' philosophy, if I may put it that way, because you will correct me, Thomas, but the combination of progressive thinking and free market thinking is something that I think has run through your research for a long time. Aaron Byrne is, let me get the title right, head of EY Parthenon Financial Services, so a principal at EY, a consulting and accounting firm, which I have to mention in this context is a very generous and long-standing supporter of the Peterson Institute. He studied at Texas A&M, at University of Illinois, where he got his MBA in 2005. And Aaron has a very comprehensive experience of advising companies throughout the financial sector and beyond. He has worked initially at GE, Bearing Point. He joined EY in 2009, and he's now connected with Parthenon, which is a consultancy that EY acquired in 2014. And he's advised firms across the segments of the financial system, buy side, technology, infrastructure, of course, banking, asset management, which I hope will give rise to a very stimulating exchange in this session. So that's all for my introduction, and over to you, Thomas.
Thank you very much for the kind introduction. So I prepared a few slides, and as Nicolas said, it's going to be 10 minutes or less. So thank you all for joining us. This is based on a long-running research program. So I'm looking at the evolution of the financial system in the US in particular, and in recent years of the role of fintech. So basically, I want to make 3 points. The first one is finally we see some healthy competition in the finance industry. And we are beginning to see the virtues of competition, that is better quality of services and lower prices. It's a long overdue process, but it's finally happening. 2, the first question I want to ask about fintech, will it increase access to asset management services? Can we hope for a more democratic asset management industry? And I think the answer should be a clear yes. 3, will fintech reduce discrimination? I would argue that's a more complicated issue. The answer is probably yes, but whether or not it's going to eliminate discrimination is probably not. And in answering this question, I hope to shed light on what I think are the key features of fintech. So let's start with the first point. So I spent too many years trying to understand the intermediation process in the finance industry. And one of the takeaways from my research from the 2000s is that if you measure globally for the entire economy, the overall cost of intermediation, it is somewhat surprisingly stable over time at around 200 basis points. So this measure is all-encompassing in the sense that it's asking, if you look at the entire US economy, you have some side that has a surplus of funds. It could be household with savings. It could be firms with excess profit. And then another side that has funding needs. And again, it could be household who wants to get a mortgage. It could be consumer credit. It could be small firms tapping loans. It could be large firm using bonds. It could be firm issuing equity. Broadly speaking, if you put all of these pieces together, you can ask, what is the gap between the return on the savers and the funding cost for the borrowers? Okay. And that number has been close to 200 basis points for more than a century, with no obvious sign of going down. And so the thing that I found remarkable and somewhat surprising is that we did not see, after the advent of computers and IT, a sharp drop in the cost of intermediation. Now, this series, you see 2 series in this figure because the green one is the one that uses essentially the raw unadjusted data, and the red one makes quality adjustment for the fact that the finance industry is providing services to a range of savers and borrowers, and the mix of borrowers and savers can change over time. In particular, when you start lending to relatively poor household or lending to relatively younger firms, it becomes more expensive on a per unit basis. So you have quality adjustments to make. That's what you have the red series, which is less than the green one, but does not change really the big picture. So that was true until the financial crisis. Since then, though, it seems to be that the unit cost of finance today is definitely lower than it was for most of the 80s, 90s, and early 2000s. And I think that part of this improvement is linked to the entry of fintech firms. So that's playing out differently in different parts of the industry, but broadly speaking, we see an improvement in quality and a decrease in the unit cost. So I think that's great. Now, there are many issues you can discuss with fintech, but the one I'm more interested in is assuming that this technological change in finance, and I should say, I don't mean to imply that fintech has to be done by small startups. I think of fintech as the deployment of technology in the finance industry. Now, it's oftentimes triggered by an entrant, but of course, it could be very well implemented at scale by an incumbent. But the key feature then is to understand, assuming that indeed it's happening, that indeed it's going to lower the cost of finance, then the question is, how will the gains be distributed among borrowers and lenders? And I think there was some worry that because of the nature of technology, maybe we're going to have winner-take-all effect and things like that. And I think there was some confusion in the debate. So to clarify that, I thought about like a framework, and the framework emphasizes the tale of two fixed costs. Okay, so the worry people have sometimes it's about increasing return and winner-take-all, but they tend to mix two types of fixed costs and not realizing that they have widely different implications. So if you think about asset management, maybe the simplest application, there are two types of costs. There is a cost of setting up the asset management system, and there is a cost per relationship, the cost per account. Okay, and what I think that what fintech does is increasing the former and decreasing the latter. So you can think of robo-advising as a system which is pretty expensive to set up. All the AI system is very expensive to set up. On the other hand, once it is set up, it does not really matter if the AI system is providing advice to 300 clients or 300 million clients. Okay, so it's a model of high fixed cost to set up, but a low fixed cost per relationship. Once you understand that, you see that that's the main reason why AI and fintech in that space is going to be good for democratizing access to finance. It's because the cost per relationship is low. The thing that triggers the inequality is the cost per relationship. In other words, people who are not wealthy cannot afford to have their own quasi full-time financial advisor. It's just too expensive. But that's a cost per relationship. On the other hand, they could very well afford the cost of using an AI advisor. So that's the key thing about the cost per relationship. Now, the cost to set it up, of course, might be higher because you need to build a system. However, the key feature there is this cost must be compensated by future profits. But most of the future profits are still going to come from the big accounts. So if you think about it from an economic perspective, what it means de facto is that wealthy households are going to subsidize relatively poor households in compensating for the big fixed cost of setting up the system. And this is why, at the end of the day, I'm quite optimistic that we're going to see, democratization of asset management services. The early data seem to be very consistent with that. So the main feature of fintech in all markets where they've entered is speed and convenience. It's not really that they are much smarter than the rest. Like if you look at mortgage application, I don't think you can make the case that they are a lot smarter, but they are a lot faster and more convenient. You can do your mortgage application at 2 a.m. if you wake up and it's all online and it goes very fast. That's their value proposition. That's how they started to gain market share. Interestingly, they don't really target the very poor population. They target people who value their time and are sometimes actually willing to pay slightly more than for traditional mortgage lenders, but for the convenience. If you broaden the scope and look at around the world, there is very clear evidence that digital inclusion has increased. So there's a nice paper by Syed Al from the IMF showing that a very large increase in digital inclusion around the world. And because of that, an improvement in access to services. Broadly speaking, we see that this is good for the young and the middle class. I think that's the main feature, exactly as you would predict from the theory. It is not clear that it's going to be great for the poor and low educated because there's still going to be a barrier linked to education. So that's the main reason why I'm very optimistic about the asset management part of fintech. Now, the credit part of fintech, I'm also optimistic, but it's a bit more cautious. So if you think about the traditional way we think about discrimination, through like classic models of majority minority groups, information bias and statistical bias, then I think that the reason to be optimistic is that some of these biases were really linked to prejudice. So it's not really profit maximizing. It's just like bad prejudice. And computers are very good at getting rid of that. And in fact, we already see from the early data that fintech algorithms discriminate 40% less than face-to-face lenders. And that's mostly the fact that there was inefficient prejudice and they get rid of it very quickly. The reason to be cautious, however, is that these algorithms are very good at learning how to make money. And it turns out that in many of these credit markets, a good way to make money is to exploit behavioral biases. So credit card companies actually are well known to be very good at doing that. Now, humans did it way before the machines, of course, by targeting the right credit card with the right language to the less educated people and hiding the fees and shrouding the language. So there is tons of research showing that has been going on for a long time. The danger there, of course, is that the algorithms can learn to do that to a larger scale. So I think in terms of, to finish up, on terms of open issues, I see two main open issues that we should tackle if we want to get the biggest bang for the buck and truly exploit the benefits from AI and fintech. The first is we need to rethink the way we regulate algorithms. And it has to be quite different from the way we regulate people. In particular, like financial regulation tends to be a long list of you have to tick the boxes. For algorithm, that's probably not the key feature to look at. The key feature is more like what is the ultimate goal of the algorithm? How is it trained? Just to give you one example, in case of credit, you can train an algorithm to replicate what people do, or so that's kind of you are training to replicate human choices. In this case, you are quite likely to actually increase biases. On the other hand, if you train the algorithm directly on outcomes variables, that is, how good was the loan ex post, not the judgment of the human being ex ante, but the actual outcome, then it's pretty clear that they're going to reduce the biases. So that's a very first order choice that has to be made. The second big issue, apart from algorithm in my mind, is the role of APIs. I mean, we always knew that data ownership was a huge issue. I think that's not new, but the growth of fintech just makes it much more salient.
Thomas, sorry to interrupt, but I suspect that 90% of our audience is familiar with API, but can you just remind us of whether that is?
Oh, sorry. Yeah. So it's just the interface that is used for two programs to interact. So if it's the thing that joins, say, the operating system on the bank side and then the operating system on another provider of services, somehow they had to be able to talk to each other. And this interface is the API. And so that's where the data would flow also. And the key issue there is that the issue of data ownership and data flow was always a big issue in finance, but fintech has just made that much more salient. And I think what we've learned is that we cannot imagine a successful open banking system without a good protocol for how these APIs are set up and how the newcomers and the existing system can interact. But we also learned that the issue of liability and traceability are very complicated, and there is no easy solution there. So I see these two things as being two key issues for regulators and practitioners going forward. I think it's 10 minutes. I don't want to be too long.
Thank you so much. This was superb, Thomas, and also a great scene setter for our forthcoming conversation. Aaron.
Thanks. And thanks, Thomas. Very compelling research and very interesting. I think that the concept of financial inclusion is one that is going to continue to permeate whether or not financial services is effectively serving societies and helping grow economy. I think when you talked about the emergence of financial technology as a disruptor, I mean, that's undoubtedly changed the way that the overall financial services market works across all different sectors. What financial technologies have done well is they provide broad access to a broader group of individuals and make it very accessible. There were two kind of core tenets that I think financial technologies brought into the space beyond just technology. One is placing the customer at the center of the execution of what it is that needs to be provided and when it needs to be provided. Additionally, they promoted very seamless access. And these are things that historically the financial services incumbent models were much more static in how they did that. Since that time, we've been over a decade since some of the earlier financial services have come into play. Many of the incumbent financial services have recognized the benefits of this. There's not a boardroom you can go into today where the center of how a customer is influencing what and how things are being provided is not front and center. Similarly, there's massive investment in incumbent financial services in creating digital channels and digital access. There's a large digital agenda that's being driven within the financial services arena. This is occurring in many different ways. Some firms have sought to build their own capabilities, to incubate their own startups, to partner with other financial technology firms, to hire talent from big tech that can help them develop and think through the way that they develop new products and processes. And some examples are like Goldman Sachs's Marcus platform, or the partnership PNC has done with OnDeck to extend small business loans. There's numerous of these examples out in the marketplace that are also shifting the way that the financial services market is playing out in the future. If you think forward and you look into what the next evolution of financial services is, it's really about having financial products and capabilities accessible to people in their everyday lives. So no longer do you have to focus on trying to go out and identify a financial service and it will come to you. It will be where you are. We see a lot of that occurring today through things like our typical interaction with payments in a vastly different way than we would have made payments several years ago. The next evolution of things in more the banking type space, you'd mentioned open banking or neo-banking. Those are models that are beginning to become more and more prevalent and being explored. I think in the US, a little bit further behind than in some other areas of the world, but it's definitely where momentum is headed. Additionally, if you look at big tech and their focus and desire to enter into financial services, they're going to push the arena even more. So I think when we think about financial inclusion and we look forward, the near term question is, does it reduce friction and create accessibility that reduce costs? I mean, the answer to that is yes. I think longer term, the benefits for how that continues to grow won't just be driven by financial technologies in particular, but it will start to be driven more by the convergence that's occurring in the marketplace. So the consolidation that's underway within financial services that's altering the market competition is occurring in many different ways. It's worked through financial services that are basically consolidating with each other. So think of the recent acquisition of E-Trade by Morgan Stanley. Firms that are buying fintechs, and you talked about APIs. Visa Plaid was a big API acquisition, where they're looking at ways to better link into broader financial institutions. And then fintechs are also looking at how do they become more traditional banks or bank charters, really for funding purposes. So this, coupled with what big tech is interested in terms of getting into financial services, will continue to blur the lines between what we call financial technology today, financial services. I mean, ultimately, it will become one thing. So does that increase inclusion? I think the answer will lean away from providing greater access and to some of the different intangible factors that are being highly discussed and debated around focusing more on stakeholder value or long-term value in addition to shareholder value. And I think that shift is one that's going to be very impactful and a strong catalyst for how we think about financial services in the future. You can see this through the emergence of things such as ESG or environmental, social, and corporate governance. And going back to asset management, that's one of the biggest places that people are investing in trying to drive opportunity. So I think that's up to 5 minutes, Nicholas. So I'll turn it back to you and we can open it up for Q&A.
Thanks so much. And I already have a few questions in the Q&A. I encourage participants to use the Q&A tool as usual as our main way to gather questions. And I actually have a clarification question from Yalman Onaran. Yalman, I think I allowed you to speak on the audio, but I'm not sure we hear you. Apparently not. Yalman, we don't hear you, so I'll ask a question. So maybe you can come back to your slides, Thomas. It was a question about the chart and the main graphic on the decline in cost. Yalman was asking whether you could clarify where you see a decrease in cost, because it was not very evident on a quick look.
Let me just get back to it.
Yeah.
Here we go. Sorry about that.
No problem.
So it's just the last part of the graph. I mean, so if you look at the average unit cost post to 2010, it's closer to 150 basis points.
We don't see your graph here, Thomas. Sorry.
Okay, so it's because
sorry for the technical.
Now, if you the one thing Zoom sometimes is not very good at, if you share screen and you have two screens at your place, sometimes you should.
Okay, see it now we kind of see it.
There we go. So no, so if you look at so these measures, of course, there's tons of factors that can move them around, and short-term volatility like this spike here, that's just about profits and losses during the financial crisis. But if you take a long-run perspective, take the average unit cost of finance in the post-2010, it's about 150 basis points. If you take the average unit cost of finance the 10 or 20 years before that, so say from 1990 to 2010, it's about 180, 200 basis points. So that's what I mean by a change. Like the unit cost is lower today by maybe a quarter compared to what it was before. So that's what I mean. In the long-term perspective, of course, there's so many things changing that you could say, well, how is it that it's not much cheaper than before? Yes, that's true. But we're serving a very different class of customers. So even though I try to adjust for all of that, I'm not sure it's perfect. But over the recent year, the data is pretty good, very consistent. So I'm very confident in comparing the 2010s to the 2000s or 1990s. That's what I meant. You can see it in individual pieces too. I mean, like clearly asset management. You see, one thing that was fascinating actually in asset management, since we are asking that question. So if you track individual assets, then there is a decline in cost. Okay, so if you track the cost of owning the S&P 500 via, okay, buying all the stocks, that's of course always been very inefficient, but buying mutual funds that track the S&P 500 or literally hold the S&P 500. Look at the cost of that strategy from the 1970s until today, where today you do it with an ETF. Okay, that cost has declined dramatically. Today it costs maybe 5 basis points, 7 basis points, like it's extremely cheap. It used to be like 20, 30, and then before that it was almost 100 basis points. So a huge decline in the cost of that specific strategy. And yet, if you look at the average asset management fees, until very recently, they did not decline. So how is that possible? Well, what happened since 1980 is that as individual fees went down, asset managers and financial advisors pushed clients into higher fee products. So the composition effect completely killed the decrease product by product. So that at the end of the day, if you look at the average fee charged by asset manager from 1980 to 2010, it was very flat. Okay, that we know is not very efficient. Okay, and what we see today is finally, we are reaping the benefits of lower fees.
Thank you. I have a question from Ted Truman, and I will try again to allow him to talk on the mic. Ted. Well, my technological attempts are not very successful.
But his Ed is muted, so maybe that's why.
Yeah, and I'm trying to unmute him, and I thought I could do that, but apparently I can't. Okay, so he has a question on the Q&A, which is why does the story not apply to banks, or if it does, how does it? Do the big depositors and borrowers subsidize the small depositors and borrowers? And how do you think of the banking piece of it? You made a mention of it, but if you can say more. And I see Ted is now unmuted. Ted.
No, that's fine. You got it.
Okay.
So for banking, I think to some extent this has happened as well. But again, if you think about it, like think about where the subsidy would come from. Imagine the banks of the pre-1980, where you had bank clerks. The number of bank clerks was roughly proportional to the number of clients. Okay, in that model, there is no cross subsidy. Now, if you move to a model where most of what you do with your bank is an app on your phone, then the cost of the app is going to be paid in practice by the big accounts, and the quality of the app is going to be a subsidy to the relatively smaller account. That's the key difference between the two models. So I think it is happening in banking, just a bit more slowly.
Aaron, do you concur?
Yeah, I think that's spot on. There's a very big focus around this in banking and how you increase digital access to banking. And during the pandemic we're in, the amount of digital usage has gone quite high relative to what it used to be in the way that people interacted with banks. I think the real distinction, and some of the things that differ in banking relatively break down to how do you think about the different products. So are we talking about deposit products? Are we talking about payment products? Are we talking about loan products? And as Thomas pointed out, there is a distinction between credit models and how those are done. And I think that's where it does still apply. It just applies differently in a financial technology model than in an incumbent model.
So
I think
yeah, go ahead.
Just to rebound on what Aaron just said. To me, one of the big puzzle or big question that I don't have the answer to is the issue of bundling and unbundling of services. And that's most important in banking, because by far banks are the ones where the bundle of services is the broadest and more intricate. And I've heard many different views on whether fintech is going to become like banks, or whether they're going to pick and choose which product they want to offer and unbundle the product. And I don't know if Aaron has a view on that, on which one is more likely to happen.
I think that the unbundling of financial services products overall, Thomas, is the next big step, to be honest, because historically the groupings of financial services were brought together by the institution and what they saw as accretive to how they perform their business. And I think that those lines are starting to break down a little bit, mostly because of the way that it started with some regulation that prevented the intermingling of certain financial services. But now you can argue the competition for financial services firms is very broad, and it's no longer just the traditional firms that were across the street. And so, as you think about what it is they're trying to provide and who they're trying to provide it to as financial services firms, that's altering. And so to do that and to think about things like open banking or the data value associated with the services provided, it will just continue to move that direction, in my opinion.
We had a session recently in this same series with Huan Yiping of Peking University about the big tech firms in China. and also my colleague Martin Chorzempa. Have either of you looked at China specifically in terms of thinking about this this issue, including the bundling, unbundling question, or do you think it's completely irrelevant outside of the Chinese space?
I haven't done a great deal of research or explored that to a significant amount, Nicholas. But what I would say is, having some connectivity to movements that are going there. Things like WePay that are used in a very prevalent way across Asia and have expanded, what they do from a technology perspective are going to be very influential. I think the financial privacy question is probably one that's very different relative to the way the governmental control is involved. But I do think there are some interesting things that are occurring, particularly around the financial technology space in China and broader Asia.
Can you expand on privacy? Because a government has access to our financial data basically in the West as well, if they want.
Yeah, there's massive requirements amongst financial services firms around how they can use PII, or personal identifiable information. Strong regulations here in the U.S., even more significant regulations in Europe. I think that there's a different level of access that presumably you could get in an environment where the government is much more closely able to access or even has ownership in financial services institutions.
Thomas, on China?
Yeah, so I actually was looking a little bit at these issues recently, and I think it's you can definitely draw two scenarios for China in the future, and they would be about whether or not they remain mostly domestic or whether they spread. So Chinese banks are very large. If you look at their assets, in fact, they are one of the largest in the world today. But they are still very domestic. So they play on, if you look at their balance sheet, it's quite large. The share of assets is even larger than the share of Chinese GDP in the world GDP. However, they are very much not interconnected. So they are not really part of the global banking system, definitely not compared to their size. And if you look at their big tech firms, you also have a little bit of a paradox in the sense that there is a sense in which they are way ahead of the West. Like the payment system in China is really different. I mean, we think of Apple Pay, but Apple Pay is just a tiny thing at for the last, not even the last mile, like the last, 10.-3 meter, right? There is no innovation in anything beyond that because it still runs on the old wires. While the innovative payment system in China, they are closed loop. I mean, they don't run through the banking system. It's very different. So in that sense, they are way more innovative. But because of the fact that it's China, they remain relatively segmented from the rest of the world. And I think the big question there, and again, I have no idea which one is going to happen, but you could really imagine two different scenarios, one in which they remain relatively insular, and that's a scenario in which I don't think it would be consistent with the Chinese currency and financial system becoming like a big safe asset, a big asset in the world. That's scenario one. Scenario two, if China really wants to project its financial might as opposed to its trade and GDP might, then it would have to open up some of its financial system. And then the question will become, will they do it via banks, like traditionally it's always been done historically, or would they do it through their big techs? And my sense is actually they would do it through their big tech if they chose to do it. But I don't know I don't think they made up their mind about that.
Do you have any interpretation of the cancellation of the Ant Group IPO in this context, Thomas?
I think it's a perfect example of the tension that are inside China. Like how do you? I think it's clearly about keeping control. It's clearly about the political leadership trying to assert the fact that they want to be in charge, and they do it in a very disruptive way. And it's hard to imagine how that would be consistent with China becoming a key player in the global financial system, because the other players would not be would not trust a system where it could be disrupted from literally overnight by a political decision. So I think that's the tension.
Literally overnight. Let's move to the rest of the world. If you think of Europe or actually other markets, Japan, Korea, anywhere else, Thomas, how do you think your analysis applies? How would you? I know your data is for the US, but how do you think of the modulation of that in different geographical environments? And I have a somewhat related question from Lynn Exton, which is about geographical inequality, right? I mean, if you think of smartphones and Wi-Fi access, and in a way you refer to that when mentioning the recent IMF research on the digital divide, but how big a constraint will be access to good internet connectivity in reaping the benefits of what you have been analyzing in terms of technology and finance?
So it's clear that you're going to have good, you're going to need good connectivity. On the other hand, I mean, the requirement in terms of data flows of finance are tiny relative to streaming movies or things like that. Or even like if you think about the data requirement for having truly driverless cars, that's an order of magnitude more. So I don't think like we're going to be constrained by the size of the pipe to send the data. The coverage, the geographic coverage, yes, but I think we're making very quick progress there. I mean, I think it's striking around the world. The biggest gains quantitatively seem to be in emerging markets. You know, they just decided to leapfrog completely the model of bank branches, and they've been quite successful. There, it seems to me at least, the limiting factor is more when you go outside the boundaries of the country. So what I find striking is the most successful systems, think of M-Pesa or Alipay or WePay, they are extremely successful domestically, but they don't really work that well cross-border, actually. They don't integrate that well with the banking system of the West, and they don't make your life easier or that much when you want to do cross-border payments. So I think that's where the challenge is going to be.
Why is that? Is that because of local cartels in advanced economies?
I think Aaron probably might have a better sense. My sense is has to do with a lot with the regulations. Now you could, whether the regulations themselves are there to protect the incumbents, yes, for sure. Sometimes there's a lot of AML and KYC that are extremely difficult to handle cross-border, and so I think that's part of the reason.
Aaron?
Yeah, a big part of it is tied to, what are the network rails that they're plugged into that they can be able to, manage through that foreign exchange and the transition of funds and money, which is something that our big providers here in the United States have worked very hard to even get inroads into places like China, which has been a challenge in terms of accessibility. So I think that it's more the shift in the access of how that connectivity works. What they do very well is within the closed loop network that Thomas was alluding to earlier, they make it very seamless within market, but their connectivity out of market is not as seamless.
So coming back to more advanced economies, let's think Europe or Japan, where you have very slow-moving banking structures, even so many people would like to see restructuring consolidation. It's not really happening. So the banking structure looks like a big obstacle to disruption. Thomas, in those markets, let's say Japan and Europe, of course, you don't have the data for unit cost of finance and how it would compare with the US, but do you have an intuition of how it would compare?
Oh, actually, we do have the data, but I couldn't show too many graphs. So if you look at Europe and Japan, actually, and you do the same kind of calculation I showed you for the US, the data is, you cannot go back in the past as much, but you can start in the mid-70s. And the striking fact is the convergence. So there used to be quite a bit of heterogeneity. For instance, the UK, as you might imagine, typically had a pretty low unit cost for a long time. And continental Europe tended to have a higher unit cost until the 1990s. Since the 1990s, you see a global convergence. And the last estimate we had was, pretty much everybody is around 150 to 200 basis points after a convergence. So yeah, the question is whether now the next wave driven by new technologies, is it going to be as beneficial in Europe as it already is in emerging markets, and how does it compare to the US? Again, I think I see two paths there. Historically, if you look at the way technological change happens, in the US, it's by entry of new firms. In Europe, it's by incumbent adapting to the technology. That's most of the 1990s, you see the stock of intangible asset growing, all the intangible investments. In the US, what happened is you had entry of firms with high intangible assets. And the old one didn't really move. So the adjustment of the US economy happened via entry of new firms. If you look at the adjustment in Europe, quantitatively at the total aggregate level, it looks very similar, maybe a bit slower, but quantitatively extremely similar. But if you dig deeper, you see that it's all a within firm adjustment. It's the existing firms who became more intangible intensive, as opposed to entry of higher intangible assets. So I think we're going to have exactly the same question here. Are we going to have the banks not changing who the banks are, but themselves, each of them becoming more fintech-like? Or are we going to have more entry of fintech firms? Because it's Europe and Japan, you would think, well, for sure, it's going to be the same guy just becoming more tech-intensive within. But I think there is a push today that at least some regulators seems to argue that it would be better if we had some entry. And so I think there's a small chance that we might see some entry in Europe and Japan as well.
Aaron, any comment on that?
Yes, I think the other factor I'll throw in there is the difference in the regulatory environments. I think one of the things that financial services firms have historically provided is safety and soundness in relation to how they're managing people's financial interactions. And I think the question that starts to be arise in financial technologies and the prevalence of finance being distributed through big tech and other places is, how is that upheld? And the reason I think that's important is it's going to be a policy choice that governments get to make in terms of what are they going to allow financial technology firms to do as they become more like traditional banks, and what are going to be the boundaries of traditional banks moving to the path of financial technologies, and what is that blend? So as a result, I think that we'll get to some intermediary place, and the key linchpin in all of that is what are consumers and clients willing to accept in terms of how they're sharing their data and information and how it's used, which is obviously one of the big questions in technology today. And it's going to become a big question in financial technology, because right now, what financial technology companies do doesn't really touch or passes through a lot of the things that are more traditionally done by the broader banking institutions to those banking institutions. So for instance, financial technology will originate a loan, but it's underwritten, its balance sheet, it's held on the balance sheet of a bank, et cetera, all the credit risk, AMLKYC that Thomas mentioned is managed there. The question is, when those converge, how is that monitored, and does that allow for the continued prevalence of financial technology in the same way?
And of course, AMLKYC is anti-money laundering and know your customer regulation. And we have a question about that from Stephen Cecchetti, back to the cross-border challenge that Thomas referred to. Stephen says, my sense is that cross-border is relatively inexpensive when there is a bank doing the AML-KYC compliance at both ends. So do you see a technology that can reduce the cost of that kind of compliance worldwide, Thomas? It's a forward-looking question.
Yeah, I mean, I think that's to me, one of the most convenient and promising thing I've seen in that space was TransferWise. TransferWise is both a true innovation, but also very much, using the existing banking framework. So it's kind of exactly in between. And I don't know, it's hard to predict. One thing I was thinking about Europe, by the way, to your question, Nicolas, is I suspect that it's going to depend a bit on how Brexit plays out. Because at the end of the day, it's still the case that, there are interesting fintech firms in continental Europe. It's better than one might have expected. So there's tons of interesting stuff going on in Germany, France, and the north of Europe. But it's still the case that the UK dominates. And so whether the fintech firms in the UK are going to think of themselves as being EU-based or not, I think that's going to have an important impact on how it plays out in Europe. And TransferWise is one example. It's Estonia, but actually really based in the UK. So I think that's and which regulations are they going to have to comply with and all of that. I think that's very hard to predict.
Back to the business model aspects, I have a question from Peter Fisher, that both of you seem to be focusing on the cost and access from the perspective of the lender and investor and saver. But what is there the same dynamic if you look at the other side, the borrower, the issuer, the cost of capital? How would you look at this if you flip the perspective, Thomas?
So yeah, so quantitatively, of course, it's. I mean, when I do my measure, the advantage of my measure, it's all encompassing, so it has to add up. So by construction, if you see a decrease, then it's going to be either the savers get a better deal or the borrowers get a better deal, or both. Now, in recent years, I think, again, the key issue is not, I don't think the issue today is the average cost of capital because it's very low. I think it's really about the distribution. Firms that have good credit standing can borrow extremely cheaply today. So I don't think that's the issue is the average. The issue is the distribution. And there, I would argue that, well, of course, it's the pandemic year. So who knows, like there's so many things that are very different. But from the pandemic, you can already see a few things. We've seen fintech firms actually being very much better than banks at advising their clients on how to switch to all online, so there you can see on the borrower side, like the advantage of having a link to a fintech firms. Sometimes as simply as accessing rescue package from the government, and sometimes in how do you change your system so you can process all of your payment transaction online as opposed to in the store. Fintech firms have been pretty good at doing that for their clients. So I think that's
which kind of fintechs do you have in mind here?
I think payment system fintechs, because they were at the forefront, and also because they have a tradition of of technology, like things like Square and these guys. So I think that's promising. And in terms of loans, we've seen fintech being able to provide loans in this in this range of values where it's hard for banks to make money. So the $5,000 to $10,000 range for loans, where it's just like the processing costs kill you if you do it in the traditional banking way. And we've seen the fintech firms being able to do that more efficiently. So I think that's the hope there.
Aaron, any comment on this?
Yeah, I mean, I think ultimately it breaks down to the legacy infrastructures that exist in the banking system or other financial services today. Financial technologies have built a very different infrastructure with no, going back to the cost of intermediation that Thomas talked about. That's been created over decades of development and structure. And so I think there's a big, one of the things that we've been very focused on is the emergence of financial ecosystems and the way that traditional institutions begin to think about co-opetition with financial technologies or moving things like we were talking about earlier, KYC, AML outside. And I think another thing that has really accelerated kind of the gap that exists between digitization that was highly prevalent in financial technology and digitization in financial services is actually the pandemic, because the divide has always been a question of, well, how do I serve my elderly client who does not want to get on to financial technology? Well, the pandemic showed that they will, and they have, and they don't want to go to a branch. And as a result of that, the digital usage has gone way up. And there was just a CEO yesterday on a conversation talking about how that has changed the way that the financial services firms will need to think about their own profitability and think about how they provide access. And so I think that that movement is happening. It's just not happening as fast as it's happening for customers.
on this question of cost sharing and distribution, I have two questions from Catherine Lynch and Bernard Delbecq, which come back to this. I mean, why would rich investors be happy with paying for entry costs? Catherine is mentioning the fact that the asset management industry typically offers fee breaks for larger accounts. So these clients' unit fees will be lower, possibly much lower than those of smaller accounts. And also there's a big cost of acquisition. So can you expand briefly, and I'll have another question before we end this, but on why you can be so confident that this kind of cross-subsidization is happening and will happen, Thomas?
I'm confident because of the technology. I mean, I think about like Citibank and Bank of America upgrading their apps. I mean, I'm supposed most of us use still some form of traditional banking. So we've seen over the past 2 years just the quality of their apps skyrocket. I mean, it used to be honestly terrible, and now it's actually pretty good. Okay, that investment it's extremely costly. That's a massive investment. Now, of course, if you have a lot of money, then maybe your prime account and maybe you get a little bit of a break. But by and large, that cost, they do it because they want to keep the big clients. But once the app is run up, there is one app. Everybody has the same app. There is no way you're going to have two apps. It's not cost efficient to have two apps.
So basically, the answer to Catherine's question is just there's no way they can differentiate the cost sharing, right? There's no way they can make
they can in some respect, but I think in the core of the technology, there's going to be one app. That's my answer. And I agree. Otherwise, at the margin, they will do plenty of things to differentiate the product, try to be cozy. I mean, you can talk to a human being if you have a big account as opposed to only a robot. They will do all of that. But I think that's still going to be second order compared to the technology.
Actually, that's another of Bernard's question on talking to a human being. Doesn't the view, I mean, in a way, you're projecting a view that everything can be done through an app. Is it not assuming more financial literacy from some of the clients than they can have? So of course, that question presupposes that having interaction with a human being is helpful in terms of making the right financial choices, which is a questionable assumption. But how do you think of the need for human contact to just explain the basics of the choices that people have?
No, that's exactly why one of my worries, which is I'm not so worried about like a pure income-based discrimination, but I do think that an education, broadly defined education-based discrimination is an issue that exists. People need to trust that they understand enough of the IT system that they feel comfortable doing these things, interacting with an app or with a robot. And I think that might require a minimum amount of financial and technological literacy. So we might see inequality in that dimension with people not being able to use it.
But if we think of the experience in developing markets like Africa or China, how does that play out? I mean, is the fact that you had a number of people who were low education profiles coming into the service, have we seen that kind of differentiation playing out?
Not as much. I think the main reason is because the literacy part is just about feeling comfortable that you understand what's going on. And I think that there the peer effects are massive. So it's enough that in a community, you have a few people who understand the app and start using it, and then everybody starts using it. And grandmother in a small village in Kenya feels perfectly comfortable using M-Pesa because she's seen people in her community. So, but again, I mean, there's still the case that you need to have this minimum amount of trust in the system, and there's no guarantee it would be true for everybody in developed markets.
So in a way, the education can, to a certain extent, and at least for some services, be provided by the community environment and the peer example. That's what you suggest.
I think so.
The one thing I'll throw in there too, Nicolas, is that we're really talking about a certain strand of financial products, and there's other financial products that even sophisticated investors would be getting access to that are much more challenging to understand for someone who's more of a retail consumer. And I think that distinction is one that's not likely to go away in the near term, and it requires a higher amount of financial education than you can get through a community.
That's right. I have a very last question for the statistical nerds, but I cannot let it go. From François Meunier, and that's specifically to you, Thomas. How do you reconcile the quasi-constant unit cost of finance? And I'm sure you've had that questions, hundreds of times. So it's just to conclude, how do you reconcile this with the figures in national accounts, for example, OECD figures, when you look at the proportion of the finance sector as a proportion of GDP, right? US 7.5% and increasing, et cetera, et cetera. So how do you compare with value added of the financial sector in national accounts?
Oh, yeah. So that's an easy answer. Asset to GDP ratio, because the unit cost is per asset. So if you have more wealth to manage relative to GDP, in fact, that's more or less the model that I wrote down. If you write a model with 200 basis points as a unit cost, you predict almost exactly the growth in GDP share of GDP of the finance industry, just looking at the growth of the asset side. There is more wealth to manage, loans and equity and everything. That explains entirely the increase from roughly 3% of GDP to 7% of GDP of the finance industry. And today, the key thing though is today is stable or slightly declining, even though assets are growing. That's why my unit cost looks better.
I knew you would have an answer to this one. Many thanks to Thomas Philippon and Aaron Byrne for what I thought was a very thought-provoking discussion on the fundamentals of finance and the impact of technology. We'll have our last session of this year, which was also the first year of the financial statement series, in 2 weeks on the 22nd, Tuesday, the 22nd of December, a little bit earlier than usual. So 1 hour earlier than today, because we'll be talking about Japan and lessons from the Japanese experience on zombification, zombie lending, zombie borrowing for other countries today. So I'll be delighted to host Professor Hoshi Takeo and my former colleague at the Peterson Institute, now visiting fellow Tashiro Takeshi, for that occasion. Thanks very much to you all for participating, particularly to our two speakers, and have a great rest of your